Good afternoon, everyone. Thanks for joining us on this Good Friday. Kind of feels like a Friday because it's been a busy week in the world, and we're glad to get together with you guys. A little town hall action. We haven't done one of these in a little while. Hope everyone's been enjoying a nice summer. Some of that insanely hot weather from a few weeks back, but now we've got really wonderful day outside. So hopefully we get through this. You guys can get out there and enjoy it. Later joining me will be Cody Smith and Neil Hunter Smith. You guys all know Cody, of course, and Neil's new to our team. If you have any questions today, please use the Q&A function and they'll be monitoring that and jump on later. I'm sure they're actually writing down questions that'll just try to make me look bad and stump me, and that's perfectly okay and quite enjoyable as well. But we'll bring them on at the end here. So we'd love to have your questions as we get rolling. Some of you may have read a letter that we sent out to clients a couple weeks ago called Mid-Year Musings. And in it, we covered a couple of topics, and we mentioned that we would talk about the elections a little bit more on this town hall. So today's the day for that. We're going to lean into that a little bit and talk about what's going on there, which is obviously a crazy time. And then we'll talk a little bit about the markets and some of the behavior stuff that we want to be thinking about and take your questions. So that's the agenda for today. Hopefully it won't go too long. A little bit data heavy today on our slides, so apologize for that in advance. I think it was just a good way to tell the story. So we'll stop and tell a couple anecdotes along the way, but there are a few slides this time. So welcome everyone, and we'll get going. A little mandatory disclosure there so that we're all good with the compliance folks, and we'll get underway. Let's start with the elections. Election mania is fully underway. When we sent out the initial invite for this, there was an assassination attempt and Biden was still in the race, and now he's pulled out and Harris is in, and it's election mania, and I bet it's just getting started. So we're probably going to have a whole silly season in front of us. So we thought we'd take some time, and it's a question that we get a lot in our meetings with clients, like, hey, what's going to happen with the election? What's going to happen with the markets in the election? What about the economy? And do I need to be worried about anything? So we'll tackle this one first today. Our thanks to Invesco, you'll see their logo at the lower left corner. We use all sorts of different folks' information when we put these on, but Invesco happened to have a couple of really great presentations in the last month. So you're going to see some of their slides today, and we wanted to give them credit for good work. This is a slide that really shows how often returns have been positive in election years. So on the screen are all the election years, and you'll notice that far more often than not, rate of return is positive. You would see that this kind of looks like the market generally. It's not that much different. So you have on your election years in green, the negative returns in the election years in red, and then the regular years in gray. It kind of has the same ratio. There really weren't too many election years that were negative, which is just interesting. I'm not sure you can draw anything from it, but most of the time the election doesn't really impact the overall return. The other thing that comes up a lot, especially in our divided country today, is Democrat versus Republican, who's better for the markets. And I think there's sort of a perception that the Republicans are the business party and that they're all about stock market, and Democrats are all about social programs, and that might be bad for business. And that's just simply not true. So when you look across the spectrum of history here from 1949 till 2023, markets do pretty well under both, thank you very much, and they really like it under split Congress, which is where we've been for a while and where many experts predict we are going to be. You'll see later, there's a bunch more to do with the economy than there is to the political party as to how the stock market performs. But I found this slide interesting because it really isn't a lot of difference there in a split Congress regarding who's president. This slide's somewhat interesting. I think it's natural to think that if volatility increases, that it must be because of the election this year. And this is a slide going back to 1960, showing the volatility other than March, which is a pretty volatile month. September and October are some of the most volatile months we have. So whether it's an election year or not, volatility happens in the fall. And we had a little bit of that volatility here in August, a little bit early, but it's kind of normal. And I don't know if it's as election related as people might think, but it's an easy narrative if there's an election year going on. This slide I really enjoyed. I found this very interesting, and we get this question a lot. So even if someone is smart enough to realize, hey, it doesn't matter who's in office, but how do we profit from who's going to be there? Because they're setting policy, and therefore certain things are going to do better. The quote unquote obvious politically focused sector is not often the right call. And here's two examples for you on how you just can't guess this stuff. So under the Trump administration, clean energy crushed it, did really well. That is not an industry that you thought would have done well under a Republican presidency. And then under Biden, ironically, it performed quite poorly. That was basically due to the economic environment in that particular industry. But if you'd have been betting based on political affiliation, you would have said, oh, when the Democrats are in charge, I'm going clean energy. And when the Republicans are in charge, I'm going oil and gas. And that would have been exactly the wrong call. So it's an interesting reminder that it's not as obvious as that. And you really should be careful about making sector bets, because I think the second most common question we get about the election after what's going to happen and is the market going to go to zero or something like that is, what should we be investing in based on who's going to be in control? And I think the answer is going to be later, all of it, because you're not sure which ones are going to perform well at which moments. And this one I'm particularly passionate about. You guys have heard us talk about these on these town halls. Neither party can claim fiscal responsibility. And that is an absolute truth, regardless of party affiliation. Our government spends like an absolute drunken sailor, and they don't seem to be showing any signs of slowing. And you see, since the financial crisis here in 2008, that as a percent of GDP, our spending really jumped up, came down a bit. And then with the pandemic, it went through the roof again, hopefully coming down a little, but it had nothing to do with political party. Democrats and Republicans alike, just huge federal outlays. And obviously that's something that we care about for the long run health of the country, but you can't count on one particular party to be the one that spends or not, because they're both doing it. This is an interesting allocation here. I think it would be understandable for someone to say, hey, I'm worried about the election. I'm not sure what's going to happen. I know I need to be invested for the long run. I'm just going to sit on the sidelines until the election's over. And so this was, I've never seen this analysis done before, but they took $100,000 and went back to 1957. And on every election year, they just didn't invest the second half of the year. And the difference was almost double, right? 6.8 million on the right-hand side, $100,000 invested in 1957 would have turned into 6.8 million. Had you skipped the second half of election years, it would have turned into 12.2 million if you had kept it fully invested the whole time. It's a dramatic difference. And I wouldn't have thought that it would have been that dramatic when you were just talking about the second half of the year. So a good example of how you simply can't control this stuff. And then this is a little bit more common. You've probably seen versions of this out on the internet, and I think it is helpful to tell the story. But we're showing two different things here based on political. It's time in the market that matters. It's not the president's political party. And so if you invested only for Democrats, if you invested only for Republicans, or if you stayed invested the entire time, they took a chunk of money and said, how did it do? I'm particularly focused on the left-hand side of this chart, where it just talks about the last 10 years. It's a little bit more recent, a little easier to comprehend. And we took $100,000 and invested it on 12/31 of 2013. And if you only put it for Democrats, you have 172K. If you only put it in for Republicans, you have 181,000. And if you invest the entire time, you have 311,000. There's a dramatic difference in outcomes. And I can't imagine trying to make that call based on who was in the Oval Office. On the right-hand side, they do that same analysis over 70 years. I wish they'd have taken $100,000, but the number would have been so big. They only took $1,000 back in 1953. And you see it was 31,000 and 50,000 if you just stayed with one party, and 1.58 million if you invested the whole time. So just massive difference over time. And we're all saying the same thing, but using some cool statistics to do it. It doesn't matter who wins. There's a whole bunch of things that matter. This will be the most important election of our time. That's said every single time at every election. But the markets will figure out a way. The great companies in our world will figure out how to be profitable and how to add value, regardless of who's in charge and what their policies are. So I think that's worth remembering as we're going into what's probably going to be a sillier season than most, by judging how we've been so far. I thought we would take a moment and talk a little bit about the current environment. As we were getting ready to do this in the last week or so, we had some real turbulence in August. It wasn't even the September, October time where turbulence sometimes happens. But we had 1,000-point down days on the Dow, and pretty quick turnaround on some of the technology stocks that were doing really well out there. And so we thought it's probably a good time to have a conversation about that, put it in perspective. Sometimes we get calls from clients who are really worried about what might be happening next. So here's some statistics to kind of put this in perspective for you. The volatility we witnessed here is really not very unusual. It was sudden, and then as we sit here today, some of it has recovered. But a couple things that I find interesting on the left-hand side, normal year on average, you have almost 3.5 pullbacks of 5% or more per year. This year we've had 2. So we're right on pace. We can maybe have another one before the end of the year, and that would be kind of normal. We often tell clients that a pullback of 10% per year happens almost all the time. That's true. Almost once per year, you have a 10% pullback. This year, we haven't had that. Believe it or not, the pullback that we just lived through was 8.5% top to bottom. It was super fast, so it felt that way. And we hadn't had one in a while. And so the market, the media certainly glommed onto it really quickly and made a big deal out of it, but it really wasn't even a full correction. And then the max intra-year decline on average is 13.5%. And as I mentioned, this one is only 8.5%. So it wouldn't surprise me at all if we were to have more of the same before we got to the end of the year. Could we have a double-digit pullback? Absolutely. Frankly, it's kind of part of being an investor. Markets get ahead of themselves, and there's a fair amount of emotion on top of fundamental analysis. And when that emotion turns, you can have a really big downturn. So just to keep that in perspective, this wouldn't be out of the norm. It's been a little while though, and so it kind of rocked everybody. And they're like, "Oh my goodness, is this going to be the beginning of something really bad?" We're still long-term optimists. You guys know this. That's probably never going to change. But courtesy of the folks at Raymond James, a couple data points that I thought was kind of interesting. If you focus on the middle slide here, this is the engine that drives stock prices eventually. And I say eventually because at any one moment in time, you could have people freaking out and markets falling in value. But if earnings grow, stock prices grow eventually because the companies are just worth more money. And as you can see here, earnings are growing. It was a very tough comp in the third quarter of 24 versus third quarter of 23, because that was when the start of the bull market coming out of the 2022 bear market happened. And on average, they're beating it by 6%, as I heard this morning on CNBC. And the forecast is for end of year growth to be somewhere around 13-14% over last year. So companies are doing well, and that has led to some of the stock prices. The other thing that's somewhat optimistic on the right-hand side of this slide, there's a record amount of cash on the sidelines. And some of you guys know this, money market rates went from 0 to 5%. And so it was very attractive now to have some money on the sidelines. My personal belief that some of this cash on the sidelines is really bond money. It's not cash. It was meant to be invested in bonds, but bonds struggled in 2022, and that money went to cash. So I'm not sure that all this cash just rushes back to the stock market, but there's no doubt that there's plenty of cash on the sidelines, and so that's typically a good sign for equity markets. And finally, I'll focus on the left-hand side of this graph here, and I find this really interesting. It's a little hard to see where today is. There's a little gray star right here on this analysis. And then the date of the first rate cut is this brown line. We don't actually know when the first rate cut's going to be. We think it might be in September. But these 3 lines and these 3 colors represent 3 different things. The middle line, the black line, is the average S&P performance following a rate cut. And you can see that it's flat for a little while, but it ends up being positive. And so there's been several rate hiking cycles over our history, and that's been the average. But what's interesting is when you break apart these 2 scenarios. So the bottom line says this is what happens 1 year after a recession occurs. And the top line is what happens if there was no recession. And so you can see there's a dramatic difference in outcomes there. And it leads to the question of, will we have a recession or not? I couldn't possibly answer that for you. I know that the chief economist at Raymond James doesn't think so. I know that a couple other economists, like folks at JP Morgan that we follow, don't think so as well. Neither do Goldman Sachs. That doesn't mean they're right. And we've talked a whole bunch of times about how consensus from economists is about as good as weather forecasting in Kansas in the spring. You're as likely to get a tornado as you are to get a sunny day. But I think it is interesting that if we don't have a recession, historically, when rates get cut, it's been pretty good for equity markets. So something to think about as we head into a season where the Fed is likely to cut interest rates, but we don't know how much. In the letter that we sent to clients a few weeks ago, we spent a fair amount of time talking about concentration. And so we kind of reiterated our core principles. And we said, here are some things that we're watching that have our attention. And this is one of them. It started back in 2023, where we said, oh my gosh, the entire market rate of return was due to a few stocks. And so this graph here from BNY Mellon really helps us look at it. And you can see the difference between what they call the Magnificent Seven, and you'll see the names at the bottom there: NVIDIA, Meta, Alphabet, Amazon, Microsoft, Apple, and Tesla, on how they have done year to date through June 30th. I couldn't get this updated through last week, but through June 30th, and they haven't moved dramatically from there, versus the S&P 500 and how they ranked in weight of the S&P 500. So you can see that the Mag 7 had done almost 33%, literally doubling what the S&P 500 had done. And at the time, they were 33% of the S&P 500, meaning that just these 7 companies were responsible for over a third of the market movements. That's a big number, and historically that has not stood the test of time. Markets change, other leaders emerge, and so we pay attention to this concentration risk, and we're doing a fair amount of work looking underneath the managers that we use to make sure we don't have more of them in our allocation than we thought. Sometimes when a few stocks really outperform, you'll see a manager in a different space sort of leak into there. We saw a large cap value manager that had Amazon and Google as 2 of its top 5 holdings. Those have historically been considered growth companies. One could argue that they're a little bit more value now, but boy, it certainly is owning the same thing in multiple places. And so we're paying attention to that because we find that could be some risk. Those of you that remember the .com era, where everybody fell in love with technology and anything that had a .com attached to it, remember how that works out if you're not careful. And so we're paying attention to it. These are all great companies. We don't think they're going anywhere, but they are a huge percentage of the index today. A couple of points that kind of further this that made us pay attention: the weight of the top 10 in the S&P 500 through June 30, 37%. The earnings contribution of the top 10, so this top 10, sorry, the previous slide was the Mag 7, but this just added 3 more stocks to it. The earnings contribution was only 27% or 26.8%. And when the earnings contribution falls below the weighting of the company in the index for too long, it starts to make you wonder if valuations have gotten a little bit stretched, because as we said, it's the earnings, it's the cash flows, it's the profits that really drive stock prices eventually. And so you want to be thoughtful about that. And so as we've talked to clients and we've been encouraging people to diversify, maybe even some of you on this call have gotten calls from us as we've taken some profits on some of these tech companies that have really run. I've seen more religious attachment recently to these technology companies that are really going strong than I have in a really long time. And when I see that kind of emotional attachment, it worries me a little bit, because that's when people make mistakes. They're not thinking about the fundamentals. They're thinking, oh, this time it's different. And every time you say this time it's different, it tends not to be. So we're looking to be prudent, diversified, and not fall too much in love with the AI trade. Although the AI trade is very hot and it's driven a bunch of these stocks forward. I'm going to transition from that for a moment, talk a little bit about the Fed and interest rates. That's been the other massive driver of what's going on recently. Fed embarked on a big rate rise program in 2022. We had the bear market, both for stocks and bonds. And then there's all these expectations. So going into July of 2023, if you'd have taken a consensus poll of all the economists out there, the consensus was there was going to be 6 cuts by the end of the year. And then that didn't materialize. As you got to the fourth quarter of that year, they said, well, there's going to be 2 cuts. And if, as you all may recall, there were no cuts. That didn't move interest rates at all. And then we got to January 24, and they said, oh, they're going to have to for sure. There's going to be 7 cuts. And we went along and there was nothing. And then the economy was really strong through to May. And now they said, well, maybe there's going to be 1 cut. And some people are saying they're not going to cut at all. And all of a sudden we have this big volatility a couple of weeks ago, and we're right back up to consensus being 5 cuts. I only show you this silly squiggly line and all these different numbers to make the point that I don't think they know what they're talking about. And we don't know what the Fed is going to do. And we can't predict the future. I think predicting interest rate moves is just like trying to predict equity market moves in the short run. it's impossible to do, and it's even harder to make investment policy out of it. So while we do think that the consensus does seem to be that in September, the Fed has signaled that they're going to start cutting rates, I wouldn't stake my life to there being 5 cuts by year end in any way, shape, or form. And I'm not going to make investment decisions that would require that kind of action to be successful. And so we can talk a little bit about what we're doing there. Maybe Cody, Neil, and myself can roundtable a little bit about how we're treating that. But I find it interesting that it's been all over the map and nobody really knows how that's going to play out. Here's an admonition to not time the Fed. We've spent a fair amount of time on our practice team talking about how long is it before cash is no longer really a good idea. And as you know, cash is never a good idea for long-term investing because you'll always lose out to inflation. But this is an example. This chart is got a couple different things on it that I want you to show. On the left-hand side, they talk about when the Fed is raising rates. In the middle of the graph, the 3 bars show when rates have plateaued or stayed relatively flat. And on the right-hand side, talk about when rates are being cut. And they're comparing cash in the blue line to short-term bonds in the orange and in intermediate-term bonds, which are 7 to 10 years long, in the gray line. Now, when interest rates are going up, you're on the left-hand side of the screen here, and you have 5% for cash, 2.9 for short-term bonds, and 2.2 for intermediate bonds. It was even worse than that in this most recent hiking cycle. Short-term and intermediate bonds got really smacked around, sometimes double-digit losses, and cash was the only thing that made you money. However, as that shifts over to when rates stop going up, you start to see how much short-term and intermediate bonds outperform cash. And once you get to a rate cutting cycle, the same thing, it's almost 3 times as much return on the longer denominated bonds versus cash. And so we're going through in our portfolios today, and where we have a little bit more room, we obviously want cash for things you're going to spend in the next year or two. We don't want there to be any risk with that sort of thing, but there is an opportunity here for fixed income to perform better. We won't be able to pick where that was, as evidenced by that screen before, where all those rate cuts predictions were wrong. But it doesn't seem like owning cash forever is a good idea. And so we are moving from the left-hand side of the graph to the right over time here. We don't know when it's going to be, but we're trying to position portfolios and our clients to take advantage of how those short and intermediate term bonds will do when rates finally do get cut, or at least if they stop going up. So something to think about. We've been talking about this in our meetings with you. It was in our letter as well. No way to time it. Bonds are never going to outperform stocks for the long run. But being stuck in cash when rates move may not be the best play long run. I'm not going to spend a ton of time on this, but this just talks about if rates fall, how bonds are positioned. It's those same different colors. We'll just focus on the orange one. If rates fall 100 basis points, which is 1%, that means an 11% rate of return for US aggregate bonds, so the typical bond index. That's not something we have seen in my professional lifetime, being about 22 years in this business, 23 years in this business. I've never seen that expectation for fixed income. So while I don't know when rates will fall 100 basis points, I know that rate of return seems better than where we were a couple of years ago, where if rates went up, bonds were going to get really hurt. And while you sat there, you weren't getting paid any interest. Now you're at a spot where you're getting paid 5%. And if rates fall, you might get a decent rate of return on the bond as well. This is just generally rate cuts being good for both stocks and bonds. And once again, we're comparing no recession on the left to recession on the right. We have 3 asset classes here. One's the red line is stocks, the yellow is bonds, and the pink is cash. If there's no recession, everything works. And we know that that's going to be great. If there is a recession, stocks get hurt, but check out how bonds did in that environment. We're not trying to predict there would be a recession. I have nothing to say there will be. But I'm not naive enough to think I can predict one coming. And so if there were, diversification seems to make more sense today than it did when rates were far lower. And so that's the premise that we're operating from, is to make sure we have enough bond exposure that if there is a slowdown, if there is a recession, that you've got your cash assets that you're going to spend, your fixed income that will hold up for a period of time, and then you have enough time to let those equities recover. Because as you can tell, stocks do far better over the long run, and they should. But there's moments where there's a bit of volatility. We spend a ton of time talking to our clients about behavior versus strategy. I think the strategists are wrong a lot, and they have a hard time picking what's going to happen, an even harder time deciding what to do when they've made their claim about what was going to happen. But behavior is something you can control. And when we sent the mid-year musings out to clients a few weeks ago, there was a couple things in behavior that were worrying me a little bit. Some was this sort of falling in love with AI stocks and everything that had to do with technology. And so even clients who are calling us and saying, hey, I want to get more conservative. I'm worried that the market's due for a crash because it's been so good recently. But can I get some of the AI stocks? How do I invest in AI? And that was very weird. That's two opposite sides of the risk spectrum at the same time. The other thing we're seeing is people were feeling pretty comfortable with investment results and sort of their net worth and how things were growing. And some of the expenditures that people had planned on had really gone far beyond. So remodels, second homes, things that they were gifting to children, et cetera, spending far, far more than they had built into their financial plans. And perhaps in their situation, it was fine. But when you see that multiple times across the board, you start to wonder if people have forgotten that volatility does happen. That doesn't predict anything, of course, but it did make us pause and say, you know what, we need to remind clients to stay disciplined, stay diversified. Let's plan for cash flow so we don't get caught sometime with a market like 2 weeks ago where you would have been selling into an almost 10% downturn. So that's something that we think about as we go into what could be a volatile fall, just with the election and general volatility in the fall as well. Some of the behaviors that don't match up with results, you talk about fund flows and people building cash. Historically, people have put more money into money market funds in election years than in other years. And as we've talked about, markets do pretty well in election years too. So that's kind of a mistake to not be investing during the investing cycle. But people naturally are worried about it. So you see by this yellow line here on the right, they're really building cash instead of putting money to work for the long run, which doesn't work well according to the numbers. This is one of my all-time favorite slides. I think when I talk about it with 401k participants or people that I've just met, their eyes kind of cross because there's a lot of numbers on it. But I really think it gets to the point of a diversified investor never having to apologize for the big mistake and making sure that you didn't sacrifice return in the process. What you'll see here are a series of time periods, and we're going to compare a diversified portfolio on the right to just a pure equity via the S&P 500 on the left. And you'll remember these time periods, 2000 to 2002, the tech wreck, S&P went down 40%, the diversified portfolio went down 15%, but the emotion in that moment was, I lost money. Nobody was like, oh, this is great, I only lost 15%. On the rebound from 03 to 07, diversification worked pretty well, bonds did pretty good and carried the day, and they're like, oh, this is great. 2008, the Great Recession, financial crisis, nobody felt good about losing less than the index, right? Index down 37, diversified portfolio down 28, horrible day, people were very scared. And then the massive rebound for the 10 years from 2009 to 19, the S&P 500 ran away from everything else. So 350% growth versus a diversified portfolio only going up 237. The emotion was, I'm not making as much money. Why am I even doing this? Diversification doesn't work. Q1 of 2020, there's our pandemic, same phenomenon. People lost money, but they didn't realize they lost less. And then the rebound from 20 to 21 before the bear market of 22, S&P 500 crushes everything else. It's up 120 over 70 to the diversified portfolio. 2022, we had that really bad bear market where both bonds and stocks lost money. So you had a 15% loss on the diversified portfolio to an 18% loss on the S&P. I don't think most clients even care about that difference. That feels pretty much the same. And now when you compare that going all the way back to 2000, you would think that diversification never worked because the emotion was this really didn't feel great, but yet you actually by just the slimmest of margins outperformed and with dramatically less volatility along the way. And I think that's a good reminder that you can't pick this stuff. And while I'm a firm believer in equities, and I will be forever, diversified portfolio can make some sense. And we're in that spot where we feel like that's more the case now than it has been forever. So thanks for humoring me on my favorite slide with all those different numbers on it, because I think it tells a good story. Another example of how diversification can work. What I like about this is if you focus on the gray line, which is a 60-40 portfolio. So the green line is all stocks, the blue line is all bonds, and the gray line is a diversified portfolio. Going back to 1950, if you look at the equity markets, over any 1 year period, for stocks, you're talking about a -40 to +50 range, right? We know they can be volatile. And even a diversified portfolio, -20 to +34, that's a big range. But what's interesting is if you just go out 5 years, if you just have a 5-year holding period, there wasn't one instance where a diversified portfolio was negative. At 10 years, even stocks were almost always positive, and at 20 years, everything was positive, including equities, and as you could see, equities dramatically outperform. If you have a long time horizon, you don't fear the volatility. If you have a short time horizon, you gotta have some stuff set aside. Diversification really works on even periods as low as 5 years. Nobody has lost money going back to 1950 if they stayed diversified. I think we've forgotten that because US equities have outperformed everything else so much, but it still holds true even with that data. And I'll kind of end here and then we'll bring on Cody and Neil and see if there was any questions today, but don't forget what drives stock prices and success of our economy. It's innovation and investment opportunities. Think about the things that have happened since the 2008 election in our world, everything from cloud computing, tablets, 3D printing, social media, autonomous cars. There's so many things. Of course, AI down there on the right is dominating the current investment environment, but so many things have been brought to the world just since '08. I know that going forward, there's going to be even more, and that really drives stock prices. And all the noise in the in-between can get you worried and make you make bad decisions. But as long as companies are innovating and doing these kinds of things, there will be growth, and that growth is going to be reflected in stock prices for the long run. I appreciate your time today. It's always fun catching up and doing a little update for everybody. We'll get this recorded and out to everyone. But let me check in with Cody and Neil, see if there's any questions for today. Hey, Code.
Hey, guys. It wasn't a ton of questions, but I had a couple here handy if you want to go through those.
Yeah,
So,
see if we can look bad on tape.
yeah, we'll see how deep we want to dive here. But let's start off with an easy one. So you talk about diversification and sort of like being prepared for volatility. Can you talk about what you want to lean into? You've mentioned fixed income. And then conversely, where would you lean into for opportunities at the same time, given what's going on with interest rates potentially going down too at some point?
Yeah, this is I guess a multi-million-dollar question, right? And we're trying to think about this in terms of the long run without being tempted to market time. And we have to be careful of that as advisors, just like clients do. I think we look at this and go, gosh, fixed incomes look better than it has at any time in our working lifetimes. So while we're not going to out earn stocks with fixed income, we're not going to get hurt there anymore either. And it feels like more allocation to that makes some sense. Then to be fair, that has not worked so far. This year, the fixed income's flat. The S&P 500 is up 12 to 14%, somewhere in that neighborhood. So it's not been something we point at and go, look, we timed it and it was right. I don't think we're trying to do that. I think we're trying to worry about the diversification risk of some of the indices and some of that concentration risk. And by adding a little bit to fixed income, we feel like we've lowered risk without giving up too much return. And we'll see how that plays out. I think another area of the market, and this is getting a lot of publicity in our circles. I'm not sure if it's reaching the general public, but every chief market strategist, every fund manager we talk to thinks small caps are where it's at. And we've had a huge divergence between how the small cap indexes have done and how the large cap indexes are doing, and it more so than we've seen in a very long time. Now that has changed a little bit. I just heard a stat for August that the small caps are the best performing sector in the last month. And they had a big run there in August or in July before we had our little volatility spat. So we don't know. We're staying diversified. You guys, as investors, you've heard us talk about a few of our managers that we've been really favorable on that have done well. And I think that's something to stay committed to, even when others maybe just ran to big tech and weren't putting stuff in small caps anymore. I don't think that's the right move. Hey, Neil, you got anything for us?
Yeah. So one question popped up here. Obviously, the most recent downturn in people's memory was 2022, where both bonds and equities had negative returns. Hard to predict, as always, but if there was going to be another downturn here in the next year or 2 years, could we see something where both bonds and equities get hit again?
Well, I'm never going to predict, so I would never say never. It doesn't make sense that they would, because in 2021, as we were heading into that time period, interest rates were on the floor. And so the only place they could go were up, and as inflation started heating up, the Fed did what they did and raised rates faster than at any time in history and went up 500% really quickly. So that obviously hurt bonds really badly. I find it hard to imagine how they would raise rates anywhere near that fast from here. Now, does it mean the bonds are going to win and do well? No, not necessarily. I wouldn't make that call. But I feel like diversification stands a far better opportunity to help in the next downturn because of where the rate cycle is now, without trying to predict how that's going to be. I'm not even close to thinking that the interest rates are going to be lowered back. And I think when we talk to clients, sometimes they're missing those 2.75% mortgages they had. And they're like, oh, if we just wait a minute, it'll be right back down there. And once again, I'm not predicting, but I find that hard to believe. We're acting like on our team here that interest rates will stay higher than they've been for quite some time. I hope they will go down a little bit from their current levels, but I don't think that necessarily it would be just a drop right back to where it was. So I think bonds will hold up better than they did in 2022. But when there's something really awful that happens, everything gets hit, and you just have to emotionally make sure that you don't make the big mistake. And that's what we'll be there for. We'll have enough cash set aside for people's spending needs so that they don't do that, which is probably our job number one. That was a decent one. That was somebody was digging deep on that one. Any others, guys?
Yeah, I can throw another one at you.
Sure.
This may be an easier one, I'm not sure, but with political stuff coming up, the state tax laws, right now they're made to change or sunset in 2025. Do you think this may be a political hot potato or not coming up here? And do you think anything could change between now at the end of 2025?
Good question. I have no idea. I have not heard a word about it on the campaign trail from either candidate, and I could just be naive, but I haven't. What Cody's asking about is the estate tax, where right now you can pass over $13 million per person to the next generation. So a couple can do 26+ million dollars. If that law expires at the end of 2025, that drops probably in half based on the inflation adjusted numbers from the old law. So you're probably talking about 14 or 15 million per family that can pass. There are a lot of clients where that could cause a substantial estate tax burden when they pass away someday. We're trying to do a ton of planning to mitigate it for folks where it makes sense, but it's also impossible to know. Boy, I don't know. I mean, I'd like to think that if it was a, clean sweep on the Republican side, I think that might get extended. If it was anything other than that, I would bet not, but I haven't heard anyone talk about it at all. I don't have a clue. So we're gonna act like it's gonna expire and have the conversations with clients, because I think we owe them that, but it's impossible to know how that's gonna go.
Oh, one more question here around our favorite asset class, or not so favorite, maybe cryptocurrency. With potential volatility arising, and everyone's opinion that maybe crypto might be a place to jump into. Give us your thoughts on that.
Man, crypto, it's so volatile. It's such a speculative play. I'll be the first to say I'm not a crypto expert, and the more I spend time thinking about it, the more my head hurts. I feel like crypto can really have a meaningful impact if it becomes stable and is a method of exchange that cuts out a bunch of middlemen, so that the blockchain and all the technology that goes with that, it could really be meaningful. The actual chasing of the value of it right now feels like almost a counterculture thing. Like, hey, I think the currencies are all messed up and they're manipulated by the government, so I'm just going to go bet on them. And so you see these wild swings in, Bitcoin especially. I don't have any way to make investment policy out of that, so I will admit to not being able to make a case for it. Obviously, from our compliance perspective, we're not able to use it, and I'm not sure we should. Clients certainly have it, and if in the recent run up, it felt pretty good about it. In the last couple of weeks, there was a bunch of volatility there. I also don't think it's worthless. I think it is going to be real, and eventually it gets figured out. Government's regulated however it's going to be, and it will be a part of our society. But man, I don't know. Good question. Thanks for that one. To say I don't have a clue about how that's going to play out. I personally don't invest in cryptocurrency. I don't understand how it adds value long run. I would like to use the blockchain and that technology to eliminate middlemen and cost and guarantee safety of transactions on the international scene. That sounds great. Just buying Bitcoin for price appreciation doesn't make sense to me.
I haven't got any other questions here in the chat, so.
No worries. Well, we thank everybody for attending. Hope you guys enjoyed the presentation. Fair amount of slides today, but it's always good checking in with everybody. Cody, Neil, thanks for all your work behind the scenes putting this thing together, and we'll look forward to seeing everyone in the fall as we watch how this election stuff unfolds and be doing all our fall reviews for everybody. Everybody have a great afternoon.